Welcome back. Today on It's the Economy, it's a China special. China's economic slowdown seems to continue, with the latest data showing that August exports fell 8.8% in dollar terms, while imports fell 7.3%. Now, will the Chinese government and the PBOC come with more stimulus measures? According to Morgan Stanley, the big problem with China is their over-leveraged local governments and the crumbling property sector, of course. To understand more, I have with me the chief Asia Economist of Morgan Stanley, Chetan Ahya. They've written a bunch of excellent reports on this issue. Chetan, good morning, and thank you very much for sparing time for us. Well, for starters, can you tell us your diagnosis of the real problem that's pulling China slower?
Well, Latha, what we've described is that China is going through this 3D problem of debt, demographics, and disinflation all coming together. So their age dependency ratios are rising. Debt to GDP has increased by about 30 percentage points since December 19. And GDP deflator has gone into deflation of minus 1.4% in the second quarter of this year. So combination of these three is resulting in a dynamic where China's nominal GDP growth has decelerated quite significantly. We expect it to be just 2.5% in the third quarter of this year. And that's making things very difficult for investors, because if your nominal GDP growth is so low, it becomes very difficult for the corporate sector to generate profits. And that kind of is resulting into a vicious condition for China right now.
Okay. So now what are you expecting in terms of the Chinese PBOC or the government? At the moment, what have they done? They've just done, what, 20 basis points rate cut? They haven't really come with a volley of measures.
Yeah, look, interest rates are already low. So policy rates are down to 1.8% after this 20 bips cut. And when you have GDP deflator and deflation, your real rates are going to be high. And there is very little that country can do or central bank can do in terms of cutting interest rates and stimulating through monetary policy. So we think that the key to China's recovery now is a fiscal policy. And at this point of time, they are still holding back on fiscal easing. In fact, in the first 7 months of the year, they've tightened their fiscal deficit by 5.5 percentage points. And this is actually somewhat comparable to what we had seen in Japan, that once you go through this major deleveraging-led slowdown, policymakers tend to stay hawkish for longer, and that actually creates their challenges or exacerbates their challenges, because once you get deflation, it gets very difficult to revive the economy back.
Can you explain a little more of your argument on why you say there is a debt and deflation loop? Your argument is that the local government financial vehicles are over-leveraged, right? Not the central government.
That's right. So in terms of the part of the economy which is in deleveraging mode right now is local government funded vehicles. That's about 45% of GDP. And if you take the formal bond issuance by the local governments, that would be another 25-30% of GDP. And then the third component is corporate sector in the property segment. So that's about 25% of GDP. So when you take the total of these three components, it's about 100% of GDP. That's the magnitude of balance sheet which is in deleveraging mode. And when you have such a large part of the economy that gets into deleveraging mode, you will get slowdown in growth rate, or what we as economists would call it as aggregate demand slowdown. And therefore you get deflation. Now, to get out of this debt deflation loop risk, they need to kickstart with fiscal expansion and stimulate aggregate demand. They can do it with initially with infrastructure. They have energy transition related capex to do, so they can take that up. But in the medium term, it has to be done through consumption, and for that the government needs to take up fiscal transfers, or call it social welfare spending. They would not do that direct transfers that the US did, or even in some ways India did. They will only be probably focused on social welfare spending, but even that is not being taken up right now. So, they have to, in the near term, kickstart through infrastructure, but from a 12 months to 24 months perspective, they have to start moving towards consumption through government spending on social transfers.
Okay. Chetan, I mean, when I read all your excellent reports, it occurred to me, is this in a very remote way like what India went through with its state-owned banks, and even for that matter, some private banks, during the period 2016 to 2018, they could not lend because they had huge bad loans, and, the government had to help out with recapitalization. So this is something like that. They have to recapitalize their local government financial vehicles so that the debt is removed and they can start lending. Is that what you're saying?
Well, these local government financial vehicles are, Latha, in form of comparable to infrastructure companies.
Okay.
So banking system so far is okay. They are relatively well capitalized. They'll of course go through some NPL rise because of the property sector. But these local government funded vehicles are largely government vehicles for infrastructure like utilities, etc. And the problem there is that they had actually created these corporate sort of entities to do infrastructure related spending. And they raised from banks and the local markets at very high rates in terms of their borrowing. And that is, let's say right now, it's believed to be about 5% cost for them in terms of the funding rates. And then in the meantime, they were able to service this debt with property sales and property sales revenue, which has now collapsed. And so they have a challenge in terms of the revenues to service this debt. They have a challenge in terms of revenues to even do their normal spending, which they anyways have to do for maintenance of their government activities. Because property-related land sales value was accounting for 40% of local government's revenues. So it is actually some kind of government, pseudo-government entities which are in trouble. And they now need to find a resolution for these local government-funded vehicles, which would be entailing some kind of debt swap with the central government. They'll have to renegotiate the interest rate and the duration for which that loan is to be paid by. So that effort is underway. We haven't yet known the formal plan from the government, but we're expecting that to be announced by October, November. But that will have to be done. And then, the key thing is that, when you are dealing with this past debt issues, that is still addressing the stock of the balance sheet or the balance sheet problems. But you also have a growth problem. And so while you are doing this adjustment in the balance sheet and restructuring of debt, they still need to figure out a plan to create support to aggregate demand, which, as I was suggesting earlier, can be done through fiscal expansion.
Got that. Now, just tell me, what should the world take away? I mean, commodity prices are dependent on what China would do. A whole host of things we buy and sell are dependent on China's growth. What should be the message for the world? Will China continue to be a disinflationary force for a better part of this year because it may not come up with such a big fiscal stimulus?
Yeah, I think the bottom line is that China will remain a disinflationary force for the world in the next at least 6 to 12 months' time. And the other way to think about it is in terms of the details of that transmission of disinflationary pressures will be through trade, commodities, and financial conditions. So trade is, China is a big partner for everybody, and everybody's core goods inflation will be seeing downside pressure because of China, and corporate sector will suffer lower pricing power. For DMs and even for some of the EMs like India, this may not be necessarily bad news because we do have some inflation pressures right now. And so this disinflationary pressure that China would sort of emanate through goods pricing would be somewhat beneficial, but it will be one major way in which China sends disinflationary pressures to the rest of the world. The second is commodities. Now, in commodities, it is not as simple to say that all commodity prices will go down. What we are observing is that China is still continuing with energy transition related capex. And so some of the base metals like copper, lithium, even to some extent aluminum, if you look at the domestic demand, that continues to be doing well. But it's really long steel products where prices are getting impacted, because that is where the property sector slowdown is weighing in quite aggressively. And then finally, the third source of impact, as I mentioned earlier, is financial condition, and that's basically through currency. And so you've seen that RMB has depreciated. And if you go back to looking at Japan in the 90s, once Japan saw inflation in fourth quarter of 1994, its currency from that point of time remained constantly weak, and its trade-weighted exchange rate kept depreciating. So if China doesn't get out of this debt deflation loop, I think this disinflationary pressure that I mentioned to you for the next 6 to 12 months could get extended, and this would be like a persistent disinflationary force if China doesn't get out of that debt deflation loop.
Okay. Well, just for the record, as Chetan is explaining, the Chinese renminbi is the weakest it has been since November 2022 at 7.3 to the dollar. And as he says, it could get even cheaper. So there will be that pressure on India as well to not, to have to react to this. Very quickly, Chetan, final question. Does that make India a more attractive prospect?
India definitely does look as a good alternative destination. From two perspectives, we are seeing multinationals are looking at India as a growth opportunity which they need to have a presence in. And at the same time, the global portfolio capital allocation is also having to move more towards India as an alternative, which is an attractive destination. So India is definitely benefiting on account of this. And as I mentioned earlier, if you get softer commodity prices or lower import prices for goods, that's helpful for India in terms of management of inflation as well. But I think the bigger story is, if you think about that 3D problem that I described for China, what that results in is a much weaker nominal GDP growth.
Yeah.
And again, borrowing from that Japan's experience, nominal dollar GDP will also be stagnating if China cannot get out of this debt deflation loop. Whereas, in India's case, it doesn't have this 3D problem. Nominal GDP growth is fine. And
Absolutely.
To the extent to which India's real growth will be much better than rest of the world, we think that in terms of dollars as well, India's nominal GDP should continue to rise much faster. So when you're looking at China versus India, for investors, if they approach it from nominal dollar GDP opportunity perspective, then India will increasingly look far more attractive than where China is going to be.
Okay. On that very optimistic note, Chetan Ahya, thank you very much indeed for joining us and explaining in such detail the problem with China. We will keep touching base with you to check out whether the Chinese are taking a leaf out of your reports and encouraging that fiscal transfer, which is most needed in China at this point in time. Not monetary stimulus, but fiscal stimulus, as Chetan explains. We have to wrap up on that note on Bazaar. After a brief break, Chartbusters.